Target apparently just solved the great American shoplifting crisis, and their grand prize is a casual $5 billion master plan to gut their own store layouts. You're listening to Earnings Unscripted, where we unpack what really happened in today's earnings. It is March 3, 2026, and we are looking at Target, ticker TGT, and their fourth quarter. So, Miro, a lot of green on the screen for them today.
Yeah, look, holiday quarters are usually a free pass for big box retailers, but this is an actual structural flex. Revenue hit $30.45 billion. That is up over 20% from Q3, and adjusted EPS came in at $2.44. Crushed expectations, up from $1.78 last quarter.
Real quick, just so the lawyers stay happy, nothing we say here is financial advice, just two friends thinking out loud. But wait, operating income spiked too, right? Because they clawed back some margin?
Right. Operating income hit $1.38 billion. Margins expanded up to 4.5%. And frankly, a lot of that top line was just the hardline segment. It spiked roughly 88% quarter over quarter to about $6 billion. Total seasonal magic.
Yeah, and Wall Street was definitely buying the magic. I mean, pre-market was a little volatile. It dipped down to like 110 early on, but once the bell rang, the stock just marched straight up. Closed up over 4% at, 120.80. Completely flat in after hours, so the gain stuck.
They stuck because management proved they finally stopped the bleeding. The whole retail theft narrative has been completely dominant for 2 years, but the CFO flat out said today that shrink is all the way back down to pre-pandemic levels. They basically found 90 basis points of gross margin just sitting there.
Which is huge because, it felt like every earnings call lately was just a localized crime report. But the piece of the call that actually felt the most human to me was the chief merchant talking about the drive-up feature, like as a busy parent just trying to avoid a full toddler meltdown in the back seat.
Best motivation in the world.
Right? And people always assumed same-day pickup would kill impulse buying. You don't wander the aisles for a throw pillow you didn't plan to buy. But Target says once you start using Drive Up, your total spend reliably climbs 20 to 30%, which is wild.
It is a captive ecosystem. You trade the impulse buy for pure volume loyalty. But look, here's the problem. They grew that digital fulfillment side so fast, they were practically packing orders inside of empty broom closets. Literally, this chief merchant said broom closets. The stores are a logistical mess behind the scenes.
Which perfectly explains that massive $5 billion capital expenditure they just announced for next year to clean it up. All right, let's get into the details on that.
So look, spending $5 billion, which is $1 billion more than they planned for last year, by the way, tells you exactly how desperate they are to fix the physical floors.
Because right now they are basically just running a warehouse that happens to let shoppers walk around inside it.
Exactly. I mean, they're shifting to what they call this Chicago market test. The idea is to take all that fulfillment load, all the cardboard boxes, and move it entirely to high-capacity nodes in the region, getting it completely out of the store backrooms. Because right now, the actual shopping experience is suffering.
Which makes total sense. Like, if you are dodging giant flatbed carts of online orders while trying to buy a lamp, it ruins the vibe. And Target is historically all about the vibe.
Right. And to fix that vibe, they are pouring capital into the stores. Over 130 major remodels this year alone. 30 new builds.
Wait, hold on. Where is that money actually going inside the store? Because $5 billion is a massive number just to, move some packing tables out of the way.
Well, a huge chunk is going straight to grocery. Over $1 billion just for food and beverage CapEx alone. That is double their historical run rate for food.
$1 billion on food? Okay, but I always thought of Target's grocery section as kind of an afterthought. Like, I'm there for a cardigan, maybe some face wash, and oh, hey, we need milk. They're not a dedicated grocer.
No, they're not. But that is exactly the point. Food is just bait.
Bait.
It is. The chief merchant actually had this great line on the call explaining it. She said, quote, "We look at it more like a portfolio. Food drives traffic to our store. It opens the box for our guests to come into our store and explore the rest." End quote.
Wow. Okay, so they just view grocery as a giant traffic trap.
Total loss leader psychology. You come in for the milk, and then you have to walk past the new home decor pop-ups. They're actually revamping their Threshold brand with these dedicated in-shop destinations across 200 locations. So you buy a $2 carton of eggs, and you leave with a $100 rug.
That is honestly brilliant. Actually, wait, there was a really specific detail about the food itself in the filing, right? They are changing what they actually sell to make us trust them more.
Yes, this was interesting. By May 2026, they're becoming the first national retailer to completely remove certified synthetic colors from all of their cereal products.
Geez, all of them? That is a massive supply chain pivot.
It is. It really just signals this intense push for a premium health halo. If they want you to trust them enough to buy their higher margin clothes and furniture, they have to look clean in the grocery aisles first. The whole Good and Gather brand is becoming a huge margin anchor for them.
Which perfectly ties back to them wanting to act like a curated department store again instead of a chaotic shipping hub. They even talked about, having their executives go into the corporate archives?
Mm-hmm. They were digging through ancient design catalogs to remind themselves of their early roots, recommitting to basically democratizing great design.
Right, because when they just act like a supply chain node, they lose that magic. So they are clearing the aisles, cleaning up the cereal, and setting the trap for us to buy things we do not actually need.
Yeah, but look, setting that trap is not cheap. And they are hiding some of the ugliness of this transition in non-GAAP adjustments.
Quick thing, what are they hiding exactly?
Look at the corporate transformation costs. Operating income took an $89 million hit this quarter. The CFO called it a non-recurring business transformation cost. It was essentially a massive lease termination charge on excess office space.
Oh, okay. So they are slimming down their corporate real estate because they had all those headquarters headcount reductions earlier this year, right?
Exactly. They dropped $161 million on these transformation charges in Q3 and now another $89 million in Q4. You know me, I get very skeptical when massive operational write-offs are just casually labeled non-recurring quarter after quarter. Eventually, you have to wonder when the transformation is actually finished.
Fair point. Cleaning up the house always costs real money before the margins get to look pretty again. So, stepping back from all this aggressive remodeling and the whole, corporate diet, where does this actually leave them heading into next year?
Well, it looks like they are betting the whole year on execution. Management put out some very confident guidance for 2026. They only expect net sales to grow about 2%, but they are projecting adjusted EPS to jump significantly to the $7.50 to $8.50 range.
Hold on. 2% revenue growth, but earnings spike while they blow $5 billion on floor plans? How does that even work?
It is the benefit of a clean slate. They absorbed nearly $500 million in tariff and inventory costs early last year. So that nasty headwind just vanishes now. Profit naturally lifts, but the physical traffic is absolutely still a vulnerability here. Core store-originated sales dropped 3.9% year over year.
Right, because without the grocery bait we just talked about, people are not wandering in anymore. We just hit buy from our couch.
Exactly.
But, they really seem to understand the emotional side of it. The CEO actually said on the call that the best compliment they get is when shoppers say, quote, my Target. That possessive loyalty, that is exactly what they're trying to rebuild with all this redesign cash.
Yeah, assuming macro trade politics do not ruin the party. The CFO got pressed on future tariff risks during the Q&A, and his answer was basically, quote, we have got the right, deep, talented team to position us, end quote.
The classic, trust us, we have great people deflection.
Right. Zero mathematical defense there. But honestly, I will say they solved the shoplifting bleed. They're fixing the broom closet fulfillment. I'm willing to concede they played a very tough retail cycle quite well.
Sorry, wait, did you just compliment a management team without a cynical footnote?
Let's not get carried away. I just said they survived it well.
I will take it as a win for them. Target is definitely trying hard to be that happy, organized destination again. And Honestly, before I inevitably open their app and order a throw pillow I definitely do not need, we should probably wrap this up. So before I go do that, if you want these earnings deep dives to just naturally show up in your feed, feel free to follow the show. We are an AI-assisted project exploring how synthetic voices can pull human stories out of dense corporate filings. So we genuinely want your thoughts. Send your ticker requests or feedback to earningsunscripted@datamadness.ca, or just grab the X link down in the show notes. Thanks for hanging out with us, and we will catch you next time.
See you then.